Oh, just I don't think that it's in the case of Walmart. There's nothing that they're going to say that's going to spoil the story. It's going to change the market narrative. Will change, and people will just be paying less for it. But like it's as we talked about before, there's no if it goes down 10%. People are saying that they stayed too long. They're not looking to buy this dip. Everyone's on board who's going to be on board.
Yeah. I mean, who
and there's nothing.
Who doesn't own this? Who doesn't own this that wants to own this?
Right, but they're not. They're can they kind of come up with like 1% comps? Well, of course they can. I mean it's so I don't think that they're going to hit the wall as much as just it's going to be something from the outside. It's going to be exogenous because they don't have really huge estimates to warn against. Did you watch that TGL stuff? We might be in kind of a post-peak streaming thing too, which makes you wonder about the Netflix, Spotify, kind of the all these cult of shit that the country watches all at once.
You mean like peak like supply?
Like the value of the WWE for Netflix. I mean, it's the idea of kind of just aggregating that audience. They're doing with the football games, where they just bought Amazon basically just bought kind of the country's attention right on Christmas. It's like, what do we do as a nation? We watch football, and that's the only thing that all of us do at the same time.
Dave, what are you talking about today?
I don't know. Healthcare?
Okay.
No. Probably bring up Lilly and how it's been acting post the bad guidance, and then just briefly touch on what the FDA red dye number 3 change means. It's really just a jerky move. So
I listened to a podcast I'll send you. Do you know who Mike Taylor is?
Yeah.
Yeah, I mean, I figured. And we talk about it when we get in the show. Actually, I'll wait. All right, I posted, Jen. Get the people, wrangle the sheep, get them in there. All right.
Wow, did you see Dave and Buster's? Getting smacked today.
It's gotten smacked consistently every day since they went up every day. So like that insider buying drove it up. Where's it at now?
It's down 7%, 23.40.
Wow.
Yeah, that's a smashing.
Good old
Enters Mexico with Win Club franchise agreement. Huh.
Oh, market was like, no, I'm not sure. You're not ready to do the guacamole business.
No. You guys need more distractions. You need more to do.
It's just the first time we talked about that stock, it just like you look at those numbers and you're like, you guys need someone who knows about capital allocation there. And the only argument of why they wouldn't do that is because they know that their model, like facing the street, will just start showing erosion, and like it already does. So I don't know. Like honestly, someone should buy those guys private. Like if that goes $16, let's buy them out, buddy, and we'll be Dave.
We should, and we'll just change our names. That'll be our whole personas. I'll be Dave, you be Buster. And
yeah, exactly.
Just we'll run the country as Dave and Buster.
100%. And then like we get Maris to come in there and like do like rapid.
Oh, actually,
that's how we'll drive traffic.
I'll be the actual Dave of Dave and Buster's, and there we go.
That's fine.
I'll be
Jeff and I could be a tag team of the Buster, like 2 Busters.
Well, Dave and Buster's. It's
Dave and Buster's, right? Like so. It's
Dave and Buster's.
There.
Yeah, that'll be the gimmick. That'll be the gimmick. There's tons of Busters.
Took out the apostrophe and changed it all.
We'll make one of those really cheap animated shows, just kind of the adventures of Dave and Buster. This thing is a flywheel. We're going to make so much coin off Dave and Buster's as a private entertainment group.
Let me tell you what we will be doing. Not opening any more stores. And
probably not going to Mexico either.
Definitely not. Like, I love how they went to Mexico right in time for Trump to tariff Mexico. Although the peso's low. So maybe they're doing some FX, Anyway, all right.
I'm not sure they got that galaxy brain going over there at Dave and Buster's. I think they might just be kind of making shit up as they go along.
Do you think Mexicans are big on playing skee ball? You think that's a national pastime like it is here?
Why not?
In Mexico?
Sure.
It is a great game. It is a great game.
I don't know if I call skee ball a national pastime.
See, you say that, but I was just when I was escaping the fires and I was out at the JW.
They had a game room, and they were all newish games. And then what did they have? They had air hockey. Air hockey has been around since the 60s, and that's still a staple of bars and video game places. So I think it's kind of pastime-esque, David.
Yeah.
Air hockey, foosball, and skee ball. That's a triple crown in some bars.
But Macke, were you good at the little game where you'd play hockey with the little guys, little stick guys versus the Russians?
Czechs?
You know what I'm talking?
Dude, Czechs, yes. CHEX, absolutely. I had one of those machines in my house where I lived before.
Of course you did. Of course you did.
They're amazing. They're amazing.
Maybe Target should start selling those, and that's their new comp driver. Bring
it
back
could just be their thing. It could just be, just lean into the Minnesota. Oh, God, I'm sick and tired of hearing what a good store Walmart is.
Well, after that disaster of a division or wild card round that both of us had, me and you, you need something to keep them
really
optimistic. How much money did Sam Darnold lose? How much money did Sam Darnold lose in those last two games? Like the
honestly,
two biggest games.
Probably 50, 60 million. Probably 50, 60 million. I mean, it was bonkers.
Right?
He looked crazy just in that second game. Just awful on Monday. Just incredible.
Okay. I guess we can get going. All right. It is January 16th, 2025. This is Wall Street Beat. I'm Ben Brey. We got Jeff Macke appropriately talking about Target today, and David Maris talking about what he talks about, which is everything healthcare and Eli Lilly. So we'll start with Jeff. Talk to us about your namesake, Target.
The hometown boys. I was raised in Targets, as you know, Ben. My dad ran Targets. So Target makes me sad. I've got Bullseye there hanging. That kind of captures my Target feeling. They came out, they pre-announced, and, it was okay. Like, I think they wanted to sell it as kind of a good thing, except they forgot why it would be good. In other words, they said, okay, our comps are up 2%. That's not so bad. Apparel and discretionary is up. That's pretty good. But they didn't take margins up, and they didn't take earnings up. And the whole reason that you own Target is because when times are kind of good, the idea is that the middle class will shop there and they pay for more for your kind of discretionary items. If Target's not making more money on discretionary, it's really hard to figure out why you own these guys. They're not making money on discretionary. They're more or less kind of staying in line in terms of their online growth. If you saw the census today, the online stores are growing 8%. Target grew their digital 9%, but it cost them money every time to make those sales. That's where their margin's going. And that's what they can offer same-day shopping. It's just kind of a bleak, lost, woozy picture. And I think they need new management. Brian Cornell's, he's had a nice run. He's been there kind of long enough. He's set to retire at the end of the year. This is going to be dead money at best. It's a value trap. I mean, I want it to go up emotionally. I want to find a trade on it. I want to do all kinds of different things with it. We talk about Costco and Walmart being too overpriced endlessly, but all of that makes me want to own Target at 13, 14 times earnings, except for earnings are going lower, and they're just going to kind of drift there, and Target's just losing both relevancy and any direction at all. It was a bummer of a pre-announcement. I think it weighs on discretionary a little bit, but at this point, Target's just kind of, they're lost, and they're not Nike, but they're not nothing either. They're about $105 billion a year business. And so that's going to be a tailwind for everyone else. I mean, it's Walmart's so huge that they can eat 10 Targets without really making a bloat. But to the degree that they're going to be taking share, they're probably taking share from Target right now. And that's just, you can see it in the stores and you see it in the stock.
And I guess
Wah,
like because
wah.
so our listeners know that haven't weren't around in the spring, Jeff had a pretty prescient call about Nike, which was, hey, like own everything but Nike. And I mean, you could have shorted Nike too, to be fair. And I had saw Nike's chart, and I was like, God, that's a bad chart. And we shorted a little bit like a year and a half ago, and made a little bit of money. But like Jeff had like a call, and he was like, they're just losing market share. And that's really kind of the tough bird to or tough thing to overcome, isn't it? Like when you start losing share and then you get in the whole let's throw spaghetti against the wall game. And
Yeah.
right?
Yeah, and these guys also been they're on the front line for the shrink thing, which that has just it's a real impact on the stores. They had Walgreens talking about in their earnings call how what, when you lock things up you don't sell as much stuff, which is the no shit Sherlock observation of all time. But maybe other people don't think about it that much. But I mean, if you have to go find a guy to get your toothpaste, you're less apt to buy toothpaste at these stores. And so Target as their shrink has quintupled or something since 2019. It's only going to be about 1%, 2% of sales. That's kind of a lot to give up. And so they don't know really why their stores exist. They're trying to run really lean stores because they want to have huge size runs because they need clothes for super obese people and really tiny people and just they want to be super diverse, and they need to narrow their focus and kind of decide what they're going to be and run in a direction. But right now, Target's lost, and they just keep staying lost, and they're going to need kind of a big think about what they're going to be and if they're going to go to clubs and what kind of format they're going to have, what they're going to carry, and just what this chain looks like in 10 years.
Yeah, and like it's tough to like be making valuation arguments where when things are kind of eroding, isn't it? Like, isn't that the classic value trap?
Well, you just want to be contrarian, right? It's this is stuff you want to buy. You want to buy because I've just been spent 10 minutes shitting on it. And it's like, you know what? That absolutely sounds like a bottom because I'm not the only guy that's ranting it or stringing it together for you. I mean, it's everyone knows a lot of these things, but at the same time, I need a catalyst for it to turn around. I need kind of a reason, a spark for it. If it's not going to be sales, if it's not going to be margins, they tried this to expand their online club. There would be sort of Walmart Plus or Prime version, and it really went nowhere. It was sort of a dead initiative. These guys just aren't as good as they used to be, and they need to be crisp if they're going to be coming out of a really sort of nasty crisis they're facing. It's what's the future of these stores? Are they the next department stores? Maybe-ish. It's a super bummer, but the stores are really sick.
Yeah, and I'm looking on my Bloomberg at like the EEG function, which is the earnings history, and you look at like 25, 26, 27 like earnings estimates since 22, and take it with a grain of salt because the sell side, as David can tell you, always take their out years down over time, almost as like a rule because they have to sell stocks. But they were 2 years ago they were thinking these guys could earn $20 this
Yeah.
year, and now we're earning 10 and that's dropping still.
Yeah.
So what's the right multiple? Like, what is the like, and then discount it, right? Like, is it 10 times maybe? And then you feel like, okay, like some Warren Buffett margin of error type thing, right? Where is that?
Right. Um, lower. I mean,
hey, look, that's a good answer, honestly.
Because I just need a reason. I need a direction. Tell me what you're going after that makes sense. It's okay. You want to do online sales. Well, that's great. Either make that number grow or explain why your margins are negative on the online and like why you want to do it. Just don't give me more half-ass initiatives. Pick a direction and go there. They should get out of electronics. I would listen to them on something like, hey, let's not carry TVs anymore. We carried them in a different time. It makes it really hard for us to sell t-shirts and televisions to you because we're freaking, we're a little pressed here and you guys are stealing a lot of stuff. So to be honest, we need to give you the best customer service possible, which is leave certain marketplaces. That would make sense. It would be bold. It would be a step away from what they're doing, but what they're doing doesn't get you to grow. It's just an erosion story. And, after people are done leaving Kohl's, they'll leave Target too.
So like I guess you know, to use this analogy with Nike, it's not so much like, hey, there's some point fair value. It's like the direction of fundamental momentum is going the wrong direction. And in order to own a stock, because there's no such a thing as a fair value really. Like we oscillate between overvalued and undervalued as kind of a
Right.
rule in the stock market. And so, you know, you just basically are saying, hey, until I see something that, and I don't need to call the bottom, until I see something that gets me excited that they're doing the right stuff and like things have stabilized and possibly are starting to go the right direction, you just very reticent and you want to be involved, honestly, right? Is that the best way to take
I
it?
completely want to be involved. I absolutely
Yeah.
just, I roam around these stores and just kind of commune with my dad like an old freak. It's a zen thing for me. I feel unhappy when Target's unhappy, and right now Target's got the blues, baby.
Okay, well, it's not the best of days for Target, and even one of its biggest fans is telling you that. So take that for what it's worth. All right, David, what are we talking about? Eli Lilly.
So yeah, a bunch of stuff. First on Lilly, it's not a good sign when you put out your guidance, your stock drops, and it's a big company, right? This is not a tiny company. Stock drops. Everyone knows it's because you missed on your new product, your obesity product, your GLP-1 isn't selling as much as you even thought. Now, I mentioned this the other day. If Lilly can't get it right a quarter that they're in, then tell me that you're going to believe Morgan Stanley's bullish, like you said, people bring down their outer year numbers, or terminal growth goes from 7% to 5%, and all of a sudden the $1,000 price target becomes something else. Look, I still want it under $700. I think it's going to get there today. It's a little tiny bounce, but you had a follow through day yesterday when the market was so strong and it was still down, and that tells me, like, you know what? There's some rotation going on. This obesity trade, as speculation, is wearing down. Now, what does happen is this becomes super profitable for them as the numbers build over the next few years. So I think they're going to have tremendous earnings leverage. That's why I say it's a great company. But right now, where the stock is, I just think it got overhyped. And the street has been, there's even a thing that goes around among healthcare traders about buy the dips. It says Lilly, buy the dips, and it has Bart Simpson on a chalkboard writing buy the dips. That's, everyone's been trained to buy the dips on Lilly. I don't think so. I think now that they've given their guidance, there's really nothing between now and the next few weeks to really care about. So where will it trade? At best, sideways. I just don't think there's any reason to chase it. I'm looking for the fat pitches, and it's not yet there. Now, on a related note, look at Viking Therapeutics, VKTX. It's such a great chart for, because I've been negative on it. I've said that if you're late to this GLP-1 party without a partner, Lilly's built more than $10 billion worth of facilities just to produce this. Novo Nordisk, the same thing. And now you have a drug in development that looks pretty good, but you have no partner. And any partner, like a Pfizer, coming in would have to pay up because the market value is so high. And they'd also, it's not just the acquisition cost. It's like, it's like you say, buying a bobcat would be kind of nice, right? They're kind of cute, but it's actually not just the cost of the food that you have to worry about. It's the medical bills when it tears you to shreds. So this is I'd say it's the same thing with Viking Therapeutics, that all of a sudden you have to build out $10 billion worth of production to do this. So all the bulls on Viking Therapeutics are on Twitter, on X, all the time saying it's a takeout. And they've said that now the stock's down more than 50% in the last 6 months. And they're still saying it, like, oh, this person, this company would be great with it. And the last little bit, you've seen companies like Merck partnered with a different company. Another large cap came out at the JP Morgan conference and said, yeah, I don't think we're that interested in partnering late to the party. Novartis said early on, they're not interested in coming late to the party. So everyone's looking at the next generation products, and this isn't that. So I'm still short. I don't think there's any great reason to like it. But down here, you do run the risk that they announce a licensing deal. I don't think they'll announce an acquisition, and maybe they get a pop. That's why I've sized it pretty small. I'm not really. I I don't like shorting that much. I don't think that individual investors really should get into the business of shorting. It's very difficult, and there's so many things that go against you. I just do it for scorekeeping, and I kind of like that one. I do want to talk about a name I haven't talked about before, which is Ambu. Ambu is a Danish company. They make one-time use endoscopy products, so things in surgical, like surgical guides and cameras that don't get used again, don't get sterilized and used again. And they have a few other businesses in anesthesia and the rest, so they're pretty diversified medical company. They pretty okay growth. I bought it a quarter ago, and I didn't bring it up.
Looks like a good time. Looks like a good time. Why'd you tell me and Jeff, man? Look at this
Well,
stock.
exactly. What the heck?
No, let me explain to you. I didn't mention. I actually had prepped it all. I even had the slides for the show, and I put it up on our internal thing, and then I deleted it at the last second. I was like, you know what? I'm going to give it another week. It promptly went down like 30%. I want to say it felt like a week, but it was probably over 2 or 3 weeks. I did a conference call with management, and they were kind of blind to this. They're like, no, things are going fine. We don't. And what I didn't realize, what I should have done is said, you know what? They're not blind to this. They're actually saying that the business is fine. And what I'm saying, what I'm looking at the stock price, I'm saying, oh, that's the business. And that's a rookie mistake. But when you're new to a stock and you're feeling the pain, you want to believe other people other than your own work. And that's what I did. So I didn't say anything about the stock because it was a big black eye of something I just bought. And so yesterday, day before, they came out and said, listen, here's the preliminary guidance for 25 results. They raised their expectations for the full financial year. Organic revenue growth, they're now guiding to 11 to 14%, up from 10 to 13. So they upgraded that. They upgraded their EBIT margin from a percentage point, but it's all going in the right direction. And they're showing endoscopy growth of 21%. So it's actually a good little business. I think that even though you look at the last jump up, you'd say, okay, well, look, I missed this. I actually think this is the baseline. This is kind of where things will be. So I'm going to meet with them down at the Barclays conference next month. But there's a long story to how even when you're doing work on these things, you fall for the trap of someone knows something better than I do. I should, and that's what I did. So I didn't add to it at the bottom, but I stuck with it, which is kind of a half a win. I know that my old hedge fund friends would say, no, that you should have added to the bottom. That's not a half a win, but I'll take it that I didn't sell as a win.
Looking at this chart, this is not an easy stock to trade. I mean, this is like EKG if you stick with the healthcare theme.
Yeah, that's why you're so much better off on like U.S. liquid markets. Like that's why people don't trade a stock like this. That's why people don't get involved. This is kind of, I like the Scandinavian and limited market companies because a lot of them, pension funds, pension funds for public workers have to invest domestically. And so they just kind of are steady buyers. So think of index funds, but in a very small pot. Now that doesn't mean they trade it. It doesn't mean when it goes down, all of a sudden they jump in. But I like that dynamic. It will never be I can't say never, but I don't see it being a giant position just because of its size. But I did the same type of thing with that ALK Abello, and it did turn out to be a giant size position over time. So I do like I like the market, but it's not for everybody, right? It's you're right. It's volatile and it's illiquid.
Yep.
I did want to bring up one last thing about your candy is going to start to look a little different in the next year or two. Red dye number 3 has been banned. Not great for food producers, not great for candy makers. It's kind of been banned in other countries, so this is not a thing that they can't overcome. It'll be pretty easy to overcome. The FDA gave them a few years or a couple of years to transition this. It's odd if you're actually making with this dye, you have a longer period of time than if you're making cosmetics or or food. All right, whatever.
I mean, maybe
guess
less people, right? Maybe there's less people, right? Like cosmetics and foods affect more people, so medicine, I don't know. I'm out of
I'm
my
sure there's
seats
a
here.
reason to it.
I'm just trying to spitball.
Yeah, I'm sure there's a reason to it. My guess is it's lobbying dollars, but it doesn't really matter. What's going on behind the scenes, though, I don't think it's going to impact companies, materially. I don't think that you short Kellogg's because of this, or I don't think that's the or Procter and Gamble. I don't think that's the real thing. What I did want to mention though is, look, this is just the exiting administration taking a win from the other. Like before RFK Jr. got involved, tell me when you heard anything about red dye number 3. And so they ban it in the week before the new administration comes in, and so then it takes away a win. Cheap, ridiculous. Either way, great for consumers. I don't care, but I will say that. It was just, I wanted to mention it because people might be confused that, who's that going to impact? I don't think it's really going to impact too many people, too many companies.
Well, except for Americans who enjoy really vibrant Fruity Pebbles. We're going to have muddy Fruity Pebbles just like the rest of the world now. I mean, it's what about America making the best damn breakfast cereals on earth? The brightest, most vivid pop. This should be the land of the free and the home of the really loud cereals. And now we just have muddy, bad colors made from actual natural ingredients. That's
You're
what
gonna have
counts.
beige Twizzlers. It's going to be.
I mean, I wish my uncle, who's the VP of marketing at General Mills up in the Minnesota land where Jeff hails from, heard that. Those boys, they're getting hit. Sugar sellers, red dye 3 sellers. They had a good run though of just kind of selling you the Captain Crunch and with the image on the front. Those cartoons are great. You got to give them the cartoons.
Oh my God, the Frankenberry! Remember Frankenberry, where you would drink the milk at the end of the cereal, and they'd be like, "Oh, it's a balanced breakfast. You got your sugar group and your milk group. Sugar, milk, and starches, baby. It's drink up."
Cinnamon Toast Crunch. I mean, I used to love drinking the milk of Cinnamon Toast Crunch. It was like a milkshake with like a little cinnamon.
How about what was the one that was little cookies? They were actually little cookies that you.
Yeah, little cookies. Little cookie. Yeah.
Cookies and milk. It actually kind of genius. Think about it.
Let's not even pretend to make cereal. Let's just make cookies.
Not even try. I mean, 23% of Target's business is basically grocery, and you can't make money in a world of fruity milk. This is maybe those are the losers. Maybe that's why Target's down today, because we're going to have less bright breakfast cereals to make now that red dye number 5 is taken off the market. See, I brought it all together there, Ben. I sewed it up for us.
You did. That was great. All right. And I just one thing to add. I was looking at that Viking. Where did you short that stock?
More than 50%. So I'm up 58.
So like 65, 70, somewhere in there.
Yeah, something like that. So
I mean,
tough week for Vikings.
Jeff just brings it back.
You want to
show here today.
I want to say it's like how Jay-Z or Brad Pitt or Angelina Jolie, right? They keep very low profiles. You don't see them doing 50 interviews or whatever. And that creates this mystique that they're way better than they actually are. And I don't want to hear from any Beyonce fans that are like, "Oh no, stop it," whatever. Okay, just to be clear, okay talent. That's all I'm going to say. But the scarcity value creates, let's have them as an LVMH spokesperson because there's this mystique. Viking went to the JP Morgan conference and started talking about partners that are interested in their programs. But the more they said, the worse it got, because it's like, well, some partners are interested in the US only. Some partners are interested in just our oral product. They're not interested in the injectable product. And you might say, well, that's fine. They're giving transparency. That's good. They're talking about people are interested. It's actually the opposite. When there's a blanket of silence, all the X people on X want to chat about is that there's deals coming. And that's fine. There's nothing to counter that. Now you start to hear, wait a second. There's not a wide group that's interested in the whole company. There are people that are interested in here and there, and those are licensing deals. That's not a buying deal. And so I think they shot themselves in the foot by trying to be like, hey, let's talk up deals. But by being so specific of, hey, no one's interested in the whole kit and caboodle, that kind of threw some water on it. I mean, it's again, I just don't see if you're if there is price competition in this and you're the unpartnered high cost manufacturer, how are you going to win against a Lilly or a Novo that aren't just at scale for the US, they're at scale globally. So you can't win that.
But isn't that
Again,
the problem with a lot of businesses? Like when we think about versus the old days when there was 7,500 public stocks in the 90s, if we look back over the last 25 years, we have said so much consolidation. And then maybe that's why the winners on the top really are so dominant now, because it's just, how do you compete with Walmart? I mean, now Target can't even compete with Walmart. Like it's getting, it's like that Marx wrote that eventually there'll just be one company. And back in the day, we used to think that was GE, but like it is kind of going that way. And I think that's one of the things that people are, and again, this is just hype, but they're excited about the deregulation because it increases competition, you know what I mean? Which is the American way. But for a while, we've been kind of the opposite, where it's just scale, return on investment, whatever pleases McKinsey and Wall Street, right? So I totally resonate with what you're saying. That's how do you compete with those guys who are operating globally with distribution systems and perfect manufacturing, etc.
my big takeaway from that is that Ben is quoting Marx. I don't know. Do we need Jeff? Do we need to report him to the new administration?
All right. I'm a stone blow. I'm a capitalist through and through. Let's be clear about that. But like, I'm just saying that's what he said. You know who he is, so he's not. It's not like I'm just randomly quoting some
Who is
other
that
guy
person
from.
I have no idea.
Okay.
Groucho,
Okay.
Harpo.
All right, let's go. I got a little bit of stuff since we got three of us. I'll sneak this in. Jen, can you bring up my chart? Actually, can you make it big and just take our faces away? Is that possible? Because I think it's kind of hard for people to see that. And the other day, it's okay. Okay, there we go. If you look at this chart, the other day, 2 days ago, which ironically was right before the bond market rallied, I was doing and updating this chart, which I put on X a few times, and I think I put on Wall Street Beats. And this is a chart that goes back since it's the whole fiat era, so post 71, and it goes stocks, total return stocks versus total return long-term bonds, because those are your two options as long-term savers. Because on the front end, sure, you get whipped around, you have reinvestment risk, but if you can lock in a 10-year bond, you know what you're going to get paid if you're willing to hold it, and stocks are an alternative as a long duration. And what you see is we are now at a historic stock to bond ratio. Like, and everybody on the talking heads, everyone hates bonds and loves stocks. And we saw this at a similar time where we had a very strong dollar and, basically a lot of questionable stocks. Let's go back to 1999, 2000. That was a previous peak. Now let's make sure we all know we never know what a peak is until in hindsight. Right? So like just because we're at this highest level of the fiat era doesn't mean it can't go higher. But I would note that after the peak, every one of these had an 18 to 24 month, with a .com being 34 months, like major drawdown of about 25 to 35% in the equity market. The only one that was short was 1987. So let me set this up for us where we're at now. I think as we come into the new administration, these guys are going to they're going to try to launch some balloons for the Doji, the government efficiency thing, to one, fund their tax cuts, and then two, to try and show the bond market that they're willing to cut the deficit. Now, I don't expect much more than 100 to 200 billion, which isn't that much, but if they can, like Jeff said about Target, we're trying to see a change in direction. This old administration just went out with a 40% increase in the deficit year over year, which is not the right sign, and the bond market's reacting to that. And so what I am curious about is if they are serious, then I think bonds are a buy, and it's going to be tough for stocks and S&P earnings because, remember, public sector deficits, private sector surpluses. And, more liquidity is always better for markets. And that's a strong dollar supportive thing. So that's good for U.S. markets. But if they don't, let's just say, I think a lot of the people in the market don't think they're going to be able to do a lot, which is I understand that as well. If they don't, I am pretty confident that the bond market is going to force their hand. Like it's like the number one issuance month of the year is February. So after that, I think we'll have a good feeling for this. Like we're coming up on earnings. The biggest earnings week of the year is coming up in 10 days. So the last week of January. And then we have a huge issuance month from the Treasury in February. And we have a new administration who's arguably bringing the most radical, different ideas to Washington in a long time. This is probably the least status quo administration that at least that I've seen. Maybe you have to go back to Reagan. And I was not very young or paying attention to stocks or the market back then, so I don't have a lot of, personal anecdotal. But that's what I think. We're coming up on a period that is going to be volatile for the next, let's call it, month to 2 months, and that the market's probably sitting here right now, not really selling off, but not really bidding either, because they're seeing the bond market. They're worried about what the administration is going to be, or not even worried. The market just hates uncertainty in general, right? And so if we can remove some of the uncertainty, I think we'll go one way or the other. I think it's going to be a good time. I think that you have to know where you're thinking things are going to go, and then be ready to be, sometimes things just get thrown out and, for nothing to do with the company itself, right? There's macro factors. And I'll give you an example just to tie the bow on that. Is last week I was short Bros, and if just on a technical short-term trade. And then on last Friday after the jobs market, the whole market sold. But then quickly, I noticed Bros wasn't selling that much, and it started to rally. And I told Jeff, I'm covering this. This doesn't. And the next thing you know, yesterday is at 60. And that's an example where sometimes you can get names that are doing well internally that on a day or 2 days or whatever, week, I don't know the exact unit, will sell off. And that's your chance to be in there buying. So, if we do have a chaotic time, I think it's a time to prepare now where we still don't have answers. I don't have answers. No one has answers. I mean, maybe the Doge guys who are not talking, which, by the way, is a data point in itself that they're not really out there talking. They're probably doing stuff. But just be ready, because I do feel as though we're embarking on one of the more volatile Q1s we've had in a while. And it doesn't help that oil prices are up and to the right lately either.
Yeah.
So
we're seeing just huge reactions. We're seeing huge reactions, huge head fakes. What it is a shit market to flame momentum. It's a crap market to be like, Lulu sounded good at ICR, let's buy them. They're down 10% since they sounded good. They couldn't hold 400, and I was just looking at them. They're down in the mid 300s already. I kind of felt like I missed the move when it happened. And, now I'm kind of not wanting to buy it, that it's much lower. So, it's you need kind of a predisposition for where you think things are going to go and just play against that. Because you're right, Ben. Things are getting choppy. We're not breaking anywhere. There's no sense chasing anything. Just have a sense for where you think it's going, and basically buy dips on stuff that you feel conviction about, but don't start dabbling. It's a shitty dabble market. I'm kind of playing obsessive names.
Yeah, it's a good market for singles. Nadine and I were I've seen a sell on the Monday, the first Monday, January 6th, for the whole market almost, and then this Monday the whole market was a buy, and so you just see this choppiness, and so if you're willing to play that game, which it's more work and stuff, that's okay. Otherwise, I do think that there's just, unless you know what these guys are going to do. It's easier to just say, hey, I'm going to take some of my chips off and I'll react versus trying to anticipate again. And I just put that chart out there to show you we're in an extreme level of, hey, private sector earnings, U.S. stocks relative to bonds. And we all act like bonds is this red-headed stepchild, but it is still the central collateral piece of the financial system. So if we break this 5% level that we kind of been rumming up against, I don't think that it's going to be all that kind to the equity market and risk assets. I mean, look, how much more pain can the mortgage, no one can get a house anymore. We're going to have 10% mortgages again. And, I don't know. I just don't see, there's two ways to resolve this issue of unaffordability, which is one, prices come down a bunch. Housing, stocks, etc. Or the other one is income goes up a lot. But I don't know, when you guys follow stocks closely, do you hear like, oh, we're going to pay them 50% more or 40% more? There's some of that, but now I hear more like Wall Street just fired 200,000 people to use AI. I mean, like, right? Like, that's more of the kind of stuff. AI is taking jobs, not like, hey, we're giving 40% more, unless it's the longshoreman, apparently.
Yeah.
Yeah, when you have,
Yeah.
and so yesterday, as a funny joke, I put together a presentation on a fake company to make fun of another company that I had read about. I literally took their presentation, the subject company, dropped it into an AI presentation thing, told them, make this funny and write about this. 3 seconds later, I get an updated presentation that doesn't look anything like the original one, but has all the content that's very similar. And it was so professionally done that I sent it to somebody who's a VC, and he's like, "This is excellent. This is hilarious." Um, I don't know how many people in investment banks actually spend time making presentations, but I think it's an army, and they rip out pages because somebody they forgot to paginate something, and they get yelled at and whatever. All of that's going to go away once people who know how to do this do that. So yeah, I don't think that there's a lot. I think there's a lot of cost coming out of that system.
Yeah, and it's interesting because, you know, if we cut out all the junior lawyers, all the junior bankers, I mean, sales and trading, for all of you who've ever interacted with sales and trading desks on Wall Street, like when I started my career right before the GFC, it was still popping, and then I just watched trader after trader be like, I'm going to go to tech or I'm out of here and whatever. Like, it used to be a great job. Well, so sales and trading's
Yeah.
deep into coal worker territory. Whereas, like, I think investment banking, that might be early days for them, which could be good for the bank's earnings, but it's how will you ever get senior bankers if you don't have like a big pool of junior bankers? You know what I mean? And like junior lawyers, like how are you going to teach these people? So like I do think that, and look,
Yeah.
this is a longer term, more philosophical like comment, not really anything to do with today's markets, but like how do you get those people? Like you're disrupting the natural like progression of these careers, right?
You're killing the
Yeah,
feedstock. Absolutely. I mean, it's. I'm using Claude. Claude is my analyst, man. I'm dumping 10 Qs into Claude and just asking it questions. And honestly, it's faster. It's better, and it's like having just kind of an upbeat analyst who's occasionally stupid, but that's no more stupid than some kid I'd be paying quite a bit of money. So that's just fine. And you kind of teach it, and it's just way faster. You can compare things, you can do the stuff that you otherwise would have so many people working on for you. I don't know. The answer is, where do you get senior bankers? Probably the same place you did before, but they're not going to be able to work Excel like Jedi mind kings, and because they're just not going to go through those reps. No one's going to sit around and build models anymore because you can have models built for you instantaneously. So you can teach kids how to do math, but they're going to use calculators as soon as they figure it out.
yeah. It's like back in the day, you knew VisiCalc and you'd put that on your resume. You put VisiCalc on your resume now, people will be like, "What?" In a couple of years, you say, "Oh, I'm great at Excel." They're like, "Okay, great. I use data rails. Who cares?" Or whatever thing you want to use.
Yeah, I mean, honestly, like Excel, it's just so funny. People are still running majority of Wall Street stuff on Excel. I know there's some people who've gone into the Python world, but like we're all like slaves to the Excel. They had such a great monopoly when you really think about it on our industry. And it's the most slow latent, like, oh, just I can't tell you how many times I'm like, oh, now my computer doesn't work anymore. All right, I think you'll call it there. This is a fun show, guys.
There is one thing I want to mention, though, Ben. One more thing, because Lifetime Fitness or Lifetime Health did have their pre-announcement today, and I was going through it right before the show, but I tried to do it while like looking one eye at you and one eye at that. Look, it looks great. The stock's up 5% today. It's going to go above 30, I think. I still hold it. I think it's a great holding for this year. When we're going to make America healthy again, you're going to use telemedicine. You're going to go to the gym. You're going to pump it up and get stronger.
All right, well, that's it. We'll leave it with that. Stronger and longer. This is Wall Street Beats. That's Jeff Macke, David Maris, and I'm Ben Brey. Have a good day, guys. That was good.